Hey everyone, welcome back to We Are Cosmic, your go-to channel for everything cryptocurrency and finance explained in a simple way. If you're new here, I'm your host, and today we're diving deep into something that has huge implications for the XRP ledger, its wallets, and the next big moves in the crypto market. So make sure you stay until the end, because what we're uncovering isn't just numbers. It's the story of how wealth, strategy, and opportunity are shaping the future of XRP in 2026. Now, let's start with a startling fact. Nearly half of all XRP wallets are almost empty. Yes, you heard that right. Around 2.5 million wallets, or 45% of the entire network, hold less than 100 XRP. At first glance, this can feel like a disaster. The casual crypto observer might scroll through this data and think, wow, retail investors have completely given up. The moon mission for XRP failed. But here's the twist. The reality is much more strategic than it appears. In the world of high-level crypto analysis, a ghost town doesn't always mean death. Sometimes it's the calm before the storm, the signal of a migration from casual retail investors to serious long-term holders. This is exactly what we're seeing with XRP right now. People with small balances, dust wallets as we call them, have either left or consolidated their holdings elsewhere. But the big players, the institutional and whale wallets, they're quietly accumulating, tightening their grip, and preparing for the next major move. To make sense of this, imagine the XRP ledger as a pyramid. The base, representing those empty or tiny wallets, is shrinking fast. Meanwhile, the top 15% of wallets controlling the majority of XRP are becoming stronger and more disciplined. This isn't chaos, it's a strategic reset. The weak hands are leaving, and what remains is a hardened core of capital ready for long-term growth. Why does this matter? Well, the fewer tokens available on the market, the bigger the impact when new demand hits. This is the principle of supply shock, a concept that can move prices dramatically. The more concentrated the supply, the more powerful the effect of even a small wave of new buyers. And that's what makes XRP so interesting in 2026. Unlike Bitcoin, which has nearly 500 million global holders, XRP still has a relatively lean footprint of about 5.5 million active wallets. This is a massive runway for adoption and price movement. Think about it. Every new retail investor or institutional pilot program entering XRP can have a larger proportional effect on its price compared to Bitcoin. Why? Because Bitcoin's market is already saturated, while XRP still has plenty of room to grow. The numbers clearly show that we are not at the end of the cycle, we're at the beginning of the next big phase, and if you've ever worried that you missed the XRP boat, this data shows that the real journey is just starting. But here's where it gets even more interesting. While retail wallets are shrinking, the infrastructure of XRP is becoming leaner and more efficient. Small-scale holders exiting isn't failure. It's a natural evolution in crypto cycles. The ledger is being cleared, dust is being removed, and a new class of investor is quietly taking over. This shift is happening before most people even notice. So in this first part, we're seeing two very different stories emerge. On the surface, it looks like despair, empty wallets, frustrated investors, stagnant prices. But if you look closer, you see the foundation for a new type of market structure, one where patient, professional investors are positioning themselves for the future, leaving behind the noise of weak-handed panic selling, where we break down crypto like no one else. In part one, we talked about the massive number of empty wallets, 45% of the XRP ledger, and why that isn't actually a disaster. Now, let's take a deeper look at how the XRP ledger is structured and what it means for the market in 2026. The XRP ledger can be imagined as a pyramid of wealth. At the bottom, you have millions of small wallets, those holding less than 100 XRP. These are the casual retail investors, sometimes called tourists in the crypto world. They bought in, held for a while, and now many have exited, leaving only dust. This isn't unusual. Markets often shake out weak hands before major growth phases. Now, the top of the pyramid is where things get really interesting. The top 15% of wallets control most of the XRP. These aren't casual traders looking for a quick flip. They are whales and institutional investors holding vast amounts, often in the range of millions or even hundreds of millions of tokens. These players are not worried about daily price swings. They are positioning for the long term and taking advantage of the retail exit to consolidate their positions. Data from the last 30 days shows a very clear trend. Small wallets are liquidating, while the largest wallets are actively accumulating. In fact, the top 5% of addresses have shown almost no outflow, meaning they're holding steady or even adding more. This behavior signals patience and strategy. key traits that can drive major price movements when supply is limited. This leads us to an important concept: supply concentration. With fewer tokens available on exchanges or in small retail wallets, the market becomes top-heavy. Normally, top-heavy sounds risky, but in crypto it can actually be bullish. Why? Because a small increase in demand can create a large upward price movement when the supply is tightly held. Essentially, the fewer tokens available for sale, the bigger the potential for a spike when new buyers enter. To put this in perspective, compare XRP to Bitcoin. Bitcoin has almost 500 million global holders, making it highly liquid and harder to move quickly. XRP, with just 5.5 million active addresses, is still a relatively small and concentrated market. This means even a moderate wave of new investors or an institutional pilot program could create a significant imbalance between supply and demand. Another critical point is the role of whales in market stability. When small retail holders sell their XRP, it doesn't vanish. The whales absorb it. They are effectively locking away supply, reducing the tokens available in the liquid market. Over time, this creates a ledger where the majority of XRP is controlled by patient, long-term investors. This consolidation is also reflected in exchange reserves. As of January 2026, XRP reserves on centralized exchanges have dropped to 1.6 billion tokens, down from 4 billion just a year ago. That's a huge reduction in circulating supply. Fewer tokens on exchanges mean less opportunity for sudden large sales, and it also sets the stage for a potential supply shock if demand suddenly surges. What we're seeing here is a structural evolution of the XRP market. The base of casual wallets is shrinking, but the apex is becoming more professional and organized. Investors are moving from hot wallets to institutional-grade custody, creating a robust framework for the ledger's long-term utility. This is exactly the kind of environment where smart money thrives and opportunistic investors can profit. So, the story isn't that retail has given up entirely. It's that the ledger is self-clearing, removing noise and weak hands while preparing the market for a more strategic phase. The empty wallets aren't dead. They are a signal that a more serious and structured accumulation is taking place behind the scenes. Your hub for cryptocurrency explained in simple, clear terms. In the last part, we explored the XRP wallet pyramid and the growing dominance of whales. Now, we're going to focus on the retail side of things, the wallets that are leaving, the dust accounts, and what analysts are calling the dead ledger theory. As of January 2026, roughly 45% of XRP wallets hold less than 100 tokens. On the surface, this might look like panic selling, disappointment, or a retail exodus signaling that XRP has failed. Many casual investors bought in during the 2024-2025 hype cycles, expecting a rapid price surge. When that didn't happen, impatience set in. These wallets, often created by first-time or speculative buyers, now sit near empty, dust. But here's the key insight: dust wallets don't necessarily indicate a dying asset. They simply reflect a shift in market structure. In crypto markets, weak hands leaving often precedes a stronger, more strategic accumulation phase. Retail investors may have exited, but the supply they leave behind is being absorbed by the top-tier holders. The dead ledger theory assumes the empty wallets signal failure, but the data tells a different story. In reality, XRP is transitioning from a retail-heavy to an institutionally driven market. The retail shakeout reduces noise and volatility caused by small holders. Those who remain, the whales and large investors, are patient, disciplined, and focused on long-term utility. They aren't chasing daily price moves. They're planning for years ahead, often preparing for mass adoption scenarios or institutional use of the XRP ledger. Visualize the ledger like a city. The empty wallets are abandoned houses. Yes, the streets look quiet, but the high-rise towers at the top are bustling with activity. The resources in these towers are concentrated, controlled, and ready for strategic deployment. When new demand enters the market, it will first hit these controlled positions, potentially triggering sharp upward price moves. Now let's talk about dust versus dominance. Dust wallets are holding almost negligible amounts of XRP, often less than 0.01% of the total supply. Meanwhile, the top 15% of wallets control the absolute majority of tokens. This gap has never been wider. The contrast between casual holders and whales is striking, and it signals a maturation in the market, a shift from speculative trading to concentrated, intentional holding. The dead ledger theory argues that the retail exodus means XRP has become irrelevant for small investors. Some skeptics even suggest it is turning into a tool for banks, leaving regular people with no reason to participate. While there is some truth in that institutions are accumulating, it's not the end of the road for retail investors. Instead, it's an opportunity. When the next major demand wave arrives, whether from new retail adoption or institutional pilots, these empty wallets could be forced to re-enter, amplifying the market impact. Data shows that over the last 30 days, small-scale wallets under 1,000 XRP have been liquidating, while large wallets holding millions are buying aggressively. This is not panic. It's calculated accumulation. Large addresses are acting like digital vaults, securing XRP for long-term utility, possibly for cross-border payments, settlements, or other large-scale use cases. Another factor confirming this trend is exchange reserves. XRP tokens held on exchanges have dropped to a 7-year low of 1.6 billion compared to 4 billion a year ago. This decline in circulating supply is critical. It means that the XRP market is becoming less liquid, and any significant surge in demand could meet very limited sell orders, creating a potential supply shock. So, the retail exit, while dramatic in numbers, is actually preparing the market for the next phase. The empty wallets are a vacuum, creating room for serious accumulation and reducing noise. This is where strategy, patience, and understanding market cycles become critical. Those who can interpret these signs are positioning themselves for a major opportunity, while casual investors risk being left behind. Your go-to channel for crypto insights made simple. In the previous parts, we explored the retail exodus, dust wallets, and the dominance of whale accumulation. Now we're going to focus on a critical piece of the puzzle: supply shocks and how declining exchange reserves are setting the stage for XRP's next major moves. First, let's define what we mean by a supply shock. In simple terms, it happens when the available supply of an asset becomes limited relative to demand. The fewer tokens available for purchase, the more any increase in demand can push prices upward, sometimes dramatically. This is exactly what's happening on the XRP ledger in early 2026. Exchange reserves, which are the XRP tokens held on centralized platforms ready for trading, have plummeted to 1.6 billion, a 7-year low. Just a year ago, reserves were around 4 billion. This isn't a random fluctuation, it's a strategic withdrawal of XRP into long-term custody, cold wallets, or institutional ETFs. When tokens leave exchanges, they are effectively locked away from immediate sale, reducing liquidity and creating a tighter market. Why does this matter for price? Think of the XRP market like a balance between supply and demand. When supply is abundant, large purchases have a smaller impact on price. But when supply is scarce, even a modest influx of buyers can cause a significant price spike. In XRP's case, the combination of retail exits, whale accumulation, and low exchange reserves is creating the perfect setup for a supply-driven rally. Here's an important detail. The top 15% of holders are not just hoarding for the sake of holding, they are positioning strategically for the utility of the XRP ledger. This means they are preparing for scenarios like cross-border payments, institutional adoption, and ETF inflows. When these use cases scale, the demand for XRP will hit a market where most tokens are already secured in long-term positions, creating a massive imbalance between supply and demand. Consider this: even if only 3% of global cross-border remittance volume starts using XRP for settlements, the tokens available for trading on the open market could be insufficient to meet that demand. In other words, the ledger could experience a supply shock so strong that the price responds with a vertical move rather than gradual growth. This is the type of market event that can create huge opportunities for those who are already positioned inside the ledger. The data also shows recent accumulation trends among whale wallets. Large transactions exceeding $100,000 hit a 3-month high in early January 2026. At the same time, smaller wallets continue to sell or remain dormant. This divergence highlights a transfer of ownership from casual retail to strategic, long-term investors, a key factor in creating the supply squeeze we just described. Another critical factor is ETF and institutional custody. As more XRP moves into ETFs or cold storage, it becomes even harder for the average investor to access significant supply. Unlike Bitcoin, which is widely distributed and liquid, XRP's top-heavy structure means that any sudden demand will mostly encounter locked supply, amplifying the price reaction. This setup also explains why analysts like Standard Chartered are projecting an $8 XRP by the end of 2026. The forecast isn't just hype, it's based on measurable liquidity constraints and the expected flow of institutional adoption. The combination of retail exits, whale consolidation, and low exchange reserves has created a mathematical certainty for potential upward pressure. To sum up, the takeaway is clear. XRP isn't stagnating, it's being strategically repositioned. Retail exits have created a vacuum, whales are consolidating, and tokens are leaving exchanges. All of this means the next surge in demand will meet a market with fewer tokens available, setting the stage for a sharp, supply-driven price move. For investors, this is where preparation matters. Knowing about exchange reserves, supply concentration, and whale activity can give you an edge in timing your entry. The window to participate in this next phase may not be open for long once institutional adoption accelerates, your space for clear and practical crypto insights. So far, we've covered the retail exodus, wallet pyramids, whale accumulation, and the looming supply shock. Now, it's time to talk about how retail investors can protect themselves and act strategically in this evolving XRP market. One of the biggest risks for small holders or casual retail investors is overexposure and lack of preparation. In a market where supply is increasingly concentrated in the hands of whales and institutions, relying on a single exchange or a single wallet can be dangerous. If that platform experiences downtime, delisting, or withdrawal issues, it can mean lost opportunities or forced sales at unfavorable prices. This is why many professional investors employ a redundancy strategy. Think of it as creating multiple safety nets to ensure constant access to your assets. For example, instead of keeping all your XRP on one exchange, they spread it across. High liquidity exchange accounts for active trading or quick access. Secondary backup exchanges to protect against platform failures or sudden outages. Primary cold storage wallets for long-term holding, completely offline, safeguarding against hacks. This three-layer approach ensures that even in extreme market conditions, you can move or sell your XRP if needed. The data shows that 55% of active wallets are increasingly professionalizing their approach. Retail investors who remain on the ledger are no longer simply holding, they are adopting strategies used by institutions. Another point to consider is portfolio diversification within XRP itself. Large holders don't just store all their tokens in one account. They split holdings into multiple KYC-compliant accounts, spreading risk while maintaining control. This is important because in 2026, XRP's market volatility can spike sharply, especially when a supply shock meets rising demand. Having access across multiple platforms allows quick action when the market moves. We also see a trend of moving from hot wallets to institutional-grade custody. Hot wallets are convenient for trading but exposed to hacks and security issues. Institutional custody or cold storage solutions ensures assets are protected from sudden technical or regulatory risks. For serious investors, these methods are no longer optional. They are a necessity for survival and strategic accumulation. For retail investors, the lesson is clear. You can't treat XRP like a casual bet. The market is evolving, and staying complacent could leave you in the 45% of empty wallets while others control the future. By using redundancy, diversifying across platforms, and considering long-term custody, you position yourself to benefit from the upcoming structural shift rather than being a victim of it. It's also important to understand the timing. When supply is low and institutions are building infrastructure for mass adoption, new retail buyers are entering a market where most tokens are already locked away. Those who prepared with redundancy and multiple access points will have a seat at the table. Those who didn't may miss opportunities, or worse, be forced to buy at the top when prices spike. Lastly, the professional approach isn't just about where you store XRP, it's also about education and strategy. Learning market cycles, smart money concepts, and risk management is crucial. Platforms like Cheeky School, for example, offer courses on Elliott Wave, whale tracking, and portfolio management. These tools allow retail investors to act more like professionals, giving them a real chance to navigate XRP's next major move successfully. Your home for simple, professional crypto analysis. In the last parts, we covered retail exits, whale accumulation, supply shocks, and professional strategies. Now we're going to wrap it up by connecting all the dots. The liquidity gap, institutional adoption, and what it all means for XRP's future in 2026. As we've discussed, nearly 45% of XRP wallets are essentially empty, while the top 15% control most of the tokens. This concentration, combined with declining exchange reserves, has created a liquidity gap, the difference between supply available for trading and total demand potential. When a sudden surge of demand enters the market, this gap becomes the engine for rapid price movement. In simple terms, fewer tokens available equals greater price impact for every buy order. Institutional adoption is now accelerating. Banks and financial institutions are moving billions of dollars onto the XRP ledger, using it as a primary layer for cross-border settlements. For example, discussions at the Davos 2026 summit highlighted XRP's growing role as a utility asset for global finance. With large players securing tokens for operational use, the supply available to retail investors is shrinking even further. This is why analysts are increasingly talking about a supply-driven price surge. Let's visualize this. Imagine the open market has 2 billion XRP available, while institutional demand for settlements and ETFs is projected to be several $billion worth. The market can't meet this demand without price movement. This is the essence of a supply shock, where scarcity meets demand, and the resulting price jump is almost inevitable. Another critical point is timing. Retail investors who exited during the last hype cycles may find it harder to re-enter at favorable prices. Those still active, the 55% who remain on the ledger, already have positions and access. They are positioned to capitalize on both institutional inflows and new retail waves. The empty wallets aren't failure, they're a vacuum that sets the stage for opportunity. Data supports this scenario. Exchange reserves are at 7-year lows, large wallet accumulation is rising, and institutional flows into ETFs and custody solutions are at record highs. The combination of these factors points to 2026 as an inflection point, where demand driven by utility and adoption permanently exceeds supply available for casual retail trading. For anyone holding XRP, this is the key takeaway. The market has shifted. Retail panic and dust wallets no longer define price action. Instead, structural liquidity and institutional activity are now the dominant forces. Understanding this helps investors act strategically rather than chasing hype or fear. Those who prepared with redundancy, multiple accounts, and cold storage are positioned for success. Those who didn't may struggle to participate in the next upward move. Finally, let's talk about opportunity. 2026 could be a defining year for XRP. The combination of a lean ledger, concentrated holdings, low exchange liquidity, and institutional adoption creates a perfect environment for sharp upward price moves. If you are part of the 55% still standing, this is your chance to navigate the market intelligently, focusing on strategy and preparation rather than emotion. In conclusion, the XRP ledger is far from dead. Retail exits have cleared the way, whales are consolidating, and institutions are adopting. The supply shock is real, and the coming months could mark one of the most significant phases in XRP's history. The message is clear. Preparation, strategy, and professional approaches are no longer optional. They are essential. So, are you in the 45% who missed the opportunity, or the 55% ready for the next wave? The choice you make now will determine whether you are a spectator or a participant in what could be a generational crypto wealth transfer. Thank you for watching. We are Cosmic. If you found this analysis valuable, check the links in the description for resources, exchanges, and professional tools to stay ahead in the XRP market. Remember, the silence on the ledger today is the sound of opportunity tomorrow.